Hi, I'm Junior Chan, founder of WealthQuant. We work as financial and tax strategists, and our focus is on education, modeling, and strategic design, helping clients connect income planning, investment considerations, and tax planning into one cohesive system instead of treating each decision in isolation. And for today, the session is for educational purposes only. Nothing discussed here is tax, legal, financial, or investment advice. At WealthQuant, we do not provide tax or investment advice. We design and evaluate strategies. We perform the modeling and analysis, and we coordinate with the proper licensed professionals, such as CPAs and attorneys, for verification and execution. So all the examples shared are illustrative purpose only. The actual outcome will depend on individual circumstances, the eligibility, the timing, the structure, and the tax law applicable at the time. So for the topic today, I want to talk about conservation easements. And the first rule of conservation easements is you do not talk about conservation easements. That's the same thing as Fight Club, right? The first rule of conservation easements is you do not talk about conservation easements. And why is that? Well, because the IRS has created an environment in which this strategy is not openly discussed. And so my goal today is to demystify the strategy. Why the secrecy? What are conservation easements anyways, and what makes them so intriguing? And we'll also explore conservation easement structures, benefits, the potential growth, and the IRS's approach, as well as the risk involved when you're using the strategy for your tax strategy. Let's go into the basics. What is a conservation easement anyways? So it is a legal agreement between a landowner and a qualified organization, such as a land trust or a government agency. And it restricts the development of the land in perpetuity, protecting that land for conservation purposes, such as protecting wildlife habitats or preserving historical sites, so that even if the property is sold or passed down to future generations, the conservation easements cannot change. So in short, it is a way for landowners to protect their property from future development, no matter who ends up in control of the property. And for our purposes, conservation easements are also a tax tool. So when you agree to restrict the use of your land to the conservation cause, the government considers that a charitable donation, and you'll get certain associated deductions. So we'll talk more about this in a bit, but let's first start with understanding more about conservation easements and the risks associated with it. So over the last few years, the IRS has become much more aggressive around conservation easements. And the reason is simple. There are some bad actors in the space that push these structures too far. They exploited the tax benefits, and in doing so, they put a spotlight on the entire category. So in essence, this is a tax shelter gold mine, according to Ron Wyden, chair of the Senate Finance Committee. And here you'll see a headline, which is a congressional tax correspondence asking IRS to work against conservation easement abuse, because there's enormous sums of money that's been made as long as the number of transactions kept growing. So this matters because this is why we need to be more specific at understanding how the IRS is cracking down on conservation easements. So they began challenging deals on technical issues that might sound minor, but are absolutely critical. They look at things like incomplete forms, weak or inconsistent appraisals, problems in the deed language, and they also started questioning intent. Was there a real charitable purpose? Was there meaningful public benefit? And the goal for these are clear. They want to discourage participation by raising the risk. And so the IRS proposed new regulations aimed specifically at syndicated conservation easements. So under these new proposed rules, a conservation easement can be labeled a listed transaction. Essentially, a presumptively abusive tax shelter if it has certain criteria. And here's the key one. If the deal is marketed as producing a charitable deduction worth 2.5 times or more than the investor's cash contribution, it's automatically suspect. That single factor triggers the problem. And there are other elements that describe most syndicated easements anyways, which are multiple investors, ownership through a partnership, the partnership donating the easement, and investors claiming charitable deductions. So those are very common in syndicated easements. But once you cross that 2.5 times threshold, the transaction becomes a listed transaction. So any taxpayer claiming the deduction now has to explicitly disclose it to the IRS. And that makes audits much, much easier and disallowance much, much faster. Historically, the IRS hasn't always won these cases in tax court. So instead, they've pushed for rules that let them bypass court altogether and simply deny the deduction. And as a result, much of the industry now has shifted away from syndicated conservation easements. And instead, many advisors now look to alternative structures with very similar objectives, but different risk profiles. And you'll hear us say something like fee simple land donations, historic easements, or direct donations of appreciated assets. And we'll talk about those next. And we can go into exactly how do conservation easements work. So when a landowner donates land or other property to a conservation easements, they give up some of the rights to the property, such as the right to develop the land for whatever purpose they want. For example, the landowner might agree to preserve the land for natural use. So it's a natural conservancy, for example. And it means that they will not be able to build on the land in the future, even if they wanted to. The donated conservation easement becomes a permanent part of the property's title, binding on all current and future owners. So in exchange for giving up the right to develop the land how they want it in the future, the landowner will be eligible for a tax deduction equal to the value of the thing they're giving up, in this case, the easement. But what is the value of the land? You might think it's just what you paid for it, but there's actually another layer. And it's talking about the concept of highest and best use. And so in terms of valuation, because this is where a lot of confusion comes from, we want to go deep dive into how valuation works and where the risks come from. There isn't a large liquid market for perpetual land easements, and these aren't traded like stocks or real estate funds. So because of that, there aren't many comparable sales to rely on. And so instead, conservation easements are generally valued using what's called a before and after approach. And what that means is, first, the appraiser looks at the property before any easement exists. This is the unencumbered value. It assumes the land can be used at its highest and best use, meaning the most valuable, legally permissible, and economically feasible use of the property. That's essentially the land's full development potential. Then next, the appraiser looks at the property after the easement is in place. This is the encumbered value. The land now has permanent restrictions. It has certain development rights limited or eliminated entirely. So the difference between these two values represents the value of the conservation easement itself. And in areas with strong development pressure, that difference between the before value and after value can be pretty significant. So here's the very critical part on the charitable deduction approaches. And they're often confused. So in the first scenario, if you're talking about conservation easements only, where you retain ownership of the land, you can still use the land. You just can't develop on it beyond the restrictions. And in that case, your charitable deduction is limited to the value of the easement, the difference between the before and the after values. In the second scenario, which is the fee simple land donation scenario, you are not just adding a conservation easement. You're giving up the entire land itself to a charitable organization. So in that case, your charitable deduction is based on the full highest and best use value of the land. But you no longer retain ownership or the use. In this example, suppose you bought the land for $1 million and an appraisal determines that the highest and best use value is $5 million. After adding a conservation easement, the value of the land drops to $2 million. So if you only donate the easement and you keep the land, your charitable deduction would be $3 million. $5 million before, $2 million after, and the difference is the easement value. But if you donate the land outright in the fee simple land donation, your charitable deduction would be the full $5 million. It's higher deduction, but no ownership anymore. And understanding this distinction is essential because the structure you choose drives both the tax outcome and the long-term implications. And this is exactly why these strategies need to be evaluated carefully, not just for the upside, but also for compliance and for risk. So how do people actually participate in conservation easements? Well, there are two paths. The first is straightforward. It's individual ownership. So the landowner already owns a property and decides to place a property into a conservation easement on that property. So they essentially restrict future development, they retain the ownership still, and they pursue the associated tax treatment. The second path, which is the most common path that we see our clients do, is syndication. This is where multiple individuals pull capital together to acquire a larger piece of land together. And the ownership is held through a partnership or pass-through entity. And this part is critical. You cannot invest in something that is marketed as a conservation easement fund. Remember, the first rule of conservation easement is you do not talk about conservation easements. And so there's no marketed conservation easement fund. And that's a problem because the entity itself has to exist for a real estate, like real purpose for real estate. It buys land, it owns land, and only later may it decide to place a conservation easement on that land or donate it to charity. The easement cannot be the investment thesis on day one, which brings us to, what I half jokingly call the first rule of conservation easements. You don't talk about conservation easement. And it's because when the tax outcome becomes the headline, that's when regulators start paying attention. And so the structure matters, the intent matters, and how something is framed is just as important as what ultimately happens. And this is why these strategies require careful design, proper sequencing, and experienced professionals involved from the beginning. And it's also why many people get this wrong. So what are the tax benefits of conservation easements? At a high level, a landowner who donates land subject to a conservation easement may be eligible for federal income tax deduction of up to 50% of their adjusted gross income in the year of the donation. And if the full deduction can't be used right away, any unused portion can be carried forward for up to 15 years. So to simplify that, when you donate land with a conservation easement, the deduction is generally tied to the land's highest and best value, not what you pay for it, not what is currently being used for, but what it could reasonably be worth under its most valuable permitted use. And here's why that matters. So imagine you buy a piece of land for $1 million, but an appraisal determines that the highest and best use of that land is actually $5 million. If you donate that land with the conservation easements, the deduction is based on that $5 million value. And now if you apply a roughly 50% combined tax rate between federal and state taxes, that means your potential tax savings are about $2.5 million, or roughly 2.5 times what you pay for the land. And in recent years, it's been common to see highest and best use valuation come in at 4 to 6 times the purchase price. And once you understand that math, it's not hard to see why conservation easements grew so quickly in popularity. It provides large deductions, and you can spread it over time. So it's highly attractive to high income taxpayers. Of course, that rapid growth is also exactly why regulators started paying closer attention. And that's why structure evaluation, discipline, and compliance becomes absolutely critical. And this is also where we help educate our clients on what projects look legit and which ones may not. So over the last decade, conservation easements actually grew rapidly in popularity. In 2018 alone, about 1.6 million acres of land were newly protected through conservation easements. And between 2010 to 2017, taxpayers claimed an estimated $26.8 billion in charitable deduction tied to these structures. So this is not a niche strategy anymore. It's actually getting massive adoption. And part of that growth was driven by something positive. It's the growing awareness of environmental issues. So people genuinely desire to preserve land and natural resources for future generations. But let's be honest, the biggest driver was the tax benefit. And those benefits are very powerful because when tax benefits scale that quickly, regulators notice. And the IRS in recent years started focusing not on conservation itself, but the abuse within the structure. So if they see any type of promotional behavior, aggressive valuations, deals that prioritize tax outcomes over the charitable intent, then they'll scrutinize it. So that regulatory response today fundamentally changed this landscape. Right. So that's good to know. Now I want to dive into the risk associated. What are the risks for investors, especially if you use this as part of your strategy? The primary risk is that the IRS could disallow the charitable deduction. And if that happens, the consequence can include back taxes, interest, penalties, and professional legal fees. So because of the increased scrutiny, this is actually not a theoretical risk. It's something investors need to assume is possible. And actually, a lot of the conservation easements projects that we know got audited. So let's start with the audit risk. Audit risk simply means that the likelihood that a tax return will be examined by the IRS. So let's say if you're participating in a listed transaction, such as a syndicated conservation easement or a similar structure, you should assume that there will be an audit. That's because these transactions are a stated focus of the IRS. And one important distinction here is the valuation audits. So the listed transactions are very likely to receive a valuation audit, which means if they have 2.5 times more, they are likely going to be audited. And unlisted transactions are far less likely to. So if the IRS disagrees with the charitable deduction, they don't just audit you. They actually have to audit the partnership or the fund that owns the land. And that's because the valuation is determined at the fund level and not actually at the individual investor level. So that's actually critical because it means that the cost of defending the valuation is typically not borne by the investor personally. And that's why most established easement funds maintain a legal defense reserve. And that's why it's so important working with experienced partners matters so much. So in terms of valuation risk, assuming that the partnership gets audited, the question becomes whether the IRS accepts the valuation. And historically, the IRS struggled to win many of these cases unless there were clear technical mistakes. But recent legal changes have shifted the landscape, especially for syndicated conservation easements. And as a result, the risk of a reduced deduction is higher today than it was in the past. And that risk generally is lower for fee simple land donation and often even lower for historical easements, which are governed by different rules. So this is why valuation experience is critical. You want appraisals handled by teams who understand every technical detail and who have experience defending those valuations in audits and legal proceedings. And WealthCon only works with partners that have those experience. For investors who understand and are willing to accept these risks, conservation-related strategy can still offer meaningful tax benefit and environmental impact. But the risks are real and they should really be understood clearly before moving forward. So to wrap this up, conservation easements can offer a unique opportunity for people who care about environmental conservation and also are looking for meaningful tax strategies. They're not risk-free, they're not for everyone, but for the right individual with the right income profile, risk tolerance, and structure, the conservation easements or similar strategies can be a powerful tool when done correctly. And we've helped many of our clients who have RSUs, large capital gains, and even just high income with these type of projects. The key is really understanding the trade-offs, understanding the risk, and working with experienced professionals who focus on the structure, the valuation discipline, and compliance. So our role is to help you understand whether a strategy like this even fits into a broader financial tax picture. So if you're curious about how conservation easements might apply to your situation, or if you want help evaluating projects and performing proper due diligence, we're happy to have that conversation. So you can book a session with us, talk us through your goals and constraints, and we can help you decide together whether this makes sense for you. Thank you.